from our studio in New York City, I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. Wall Street CEOs grilled on Capitol Hill, and the leaders, including JP Morgan's Jamie Dimon, taking aim at new capital requirements, warning that everyday Americans will be the ones who pay the price for increased regulation. We've got the highlights from the testimony, plus a look at one issue where bank CEOs and Senator Elizabeth Warren agree: crypto.
Plus, oil prices breaking below $70 a barrel, crude sliding to its lowest levels since June. It's amid growing concerns about fuel demand, and we have a look at how to invest in the energy space and what to expect for oil in 2024.
And later this hour, the premiere of Goodbye or Goodbye. We're highlighting two stocks with a veteran Wall Street trader. He's going to explain which you should consider adding to your portfolio and the other to avoid. We'll help you navigate the best moves at 3:30 p.m. Eastern Time. Let's get you up to speed on the market action this afternoon. Once again, Josh, we find ourselves here at 3 p.m. and stocks kind of not seeing this week has really been characterized by smaller moves in the markets as people kind of take a step back. Right now, the Dow isn't even moving a point. The S&P 500 down just 0.1%. The Nasdaq down about the same. But if you dig beneath the surface, as always, there are some interesting moves. And what's really caught my eye today has been the continued move in energy stocks, which are down about 1.5%. And that's, of course, as we see oil prices continue to pull back as well.
Yeah, it's interesting. I mean, you did see, of course, OPEC and its allies. They came out, they made headlines, remember, announcing those deeper production cuts that got a lot of attention, but not a lot of belief there, and that hasn't been enough so far here to really stop the slide.
Yeah, definitely not. I've been looking at some of the numbers recently as well. The S&P 500 Energy Index made a recent high in September. Since then, it's down about 13%. What's interesting is oil itself, crude oil, made its high a little bit after that, and it's down twice that in that time. So energy stocks haven't fallen as much as underlying oil prices. If you look at the stats for the year, energy is actually not the worst performing group in the S&P 500. You want to take a guess?
No, hit me. What is it?
It's utilities. Utilities are performing worse, although they've seen a bounce more recently as we've seen a shift in interest rates. But it's been interesting to watch the moves in energy in particular.
Yeah, one trend we'll keep an eye on.
Yes.
CEOs, meanwhile, from the nation's largest banks are gathering on Capitol Hill today and testifying before Congress for the annual oversight hearing. Bank execs discussing a wide range of topics for the annual oversight hearing, but the Basel Endgame, which focuses on the amount of capital that banks must have in reserve to protect themselves from insolvency, was the focal point. For more coverage on today's hearing on Capitol Hill, we turn now to Yahoo Finance's Jennifer Schonberger. Jennifer.
Josh, CEOs from the nation's largest banks questioned for 3 hours by the Senate Banking Committee this morning in what's become an annual oversight hearing of Wall Street. The main message from CEOs in unison: the Federal Reserve's proposed capital requirements will hurt consumers, first-time homebuyers, and the economy.
If you have the same capital requirements increased by 20% to do the exact same activities you did yesterday, you have to get a higher return, and that higher return will be borne by the customer base.
JP Morgan Chase CEO Jamie Dimon warning that the capital plan will increase inflation by way of increasing capital requirements for hedging, which will trickle down to consumers in the form of higher prices for everything from a can of soda to meat products. Many Republicans were in agreement with bank CEOs and expressed concern over credit availability and the impact on the economy. Senator Mike Rounds asked the CEOs to raise their hands if the capital proposals would hurt first-time homebuyers.
I'm going to ask you to raise your hands. I apologize for that. But if you agree with these assessments, would you please raise your hands? Do you believe in its current form, could these regulations negatively impact first-time homebuyers?
Even moderate Democrats expressed concern about the rule, expressing concern that we could see activity move from the regulated banking sector into the non-regulated banking sector, and expressing concern about the timing of this rule. Senator Mark Warner.
My questions on Basel III have been raised already. I've indicated I think the timing at this moment is very problematic with interest rates as high as they are.
But Senate Banking Chair Sherrod Brown would have none of it, saying that bank CEOs don't want capital requirements to move higher because they don't want to sacrifice profits. I caught up after the hearing with Bank of America CEO Brian Moynihan and asked him whether he thought he was able to change the narrative at all. He told me they had a fruitful discussion with senators. When asked whether he would be prepared to take this to court if the current rule were to pass in its current form, he told me, we'll see. Back to you.
Our Jennifer Schonberger, thanks so much. Really appreciate that summary of what has gone on today. Well, from Basel III to rising debt to a possible recession, it's a busy day on Capitol Hill. Those bank CEOs testifying in front of Congress for its annual oversight hearing and clashing with lawmakers over capital hikes and other new regulations. For more on those hearings on Capitol Hill, we bring in Chris Whan, Whan Global Advisors Chairman, and of course, longtime watcher of the financial industry. Chris, it's great to get you here to get your take on what we saw today and the regulations that could be put in place. Now, I know there's a lot to sort of comb through here. But broadly speaking, when the bank CEOs make the assertion that this is going to be bad, not just for their profitability, but for America, is that a credible assertion? Are they right?
Yes, the Basel regs have mostly pushed banks out of lending to, the bottom third of consumers, particularly in the mortgage market. Banks are out of government lending, FHA, VA lending. So if we go forward with this proposal, I think you would see most banks get out of all agency and government mortgage lending, and then they'll just do jumbo mortgages, which have a little bit less regulatory burden. This proposal, Julie, is like something that was on hold for 5 years and no one worked on it. And then the Biden administration pulled it out and said, let's do it. There's no backing for this. There's no prior art in terms of the analytics, the way we normally do with the Basel process. So I do think if you look at the questions asked by Senator John Kennedy, I do think the industry could sue the Fed over this proposal because there's no rationale here, first off. And secondly, they're not focused on the real problem, which is market risk caused by monetary policy. That's why Silicon Valley failed, very simply. So Diamond's comments were great. He got right into this, and he said there is a pattern in Washington of regulatory actions with no basis. And as someone who works in housing, I can testify to that. There's half a dozen other proposals from the Biden administration that really make no sense. I mean, to be fair, I just can't justify them. So,
and Chris, so this proposal, obviously, you see real problems with it. But what is, Chris, the problem they are trying to solve for, they think they're solving for?
They think that they're still fighting a credit risk battle. But the reality is we need to focus much more on market risk and also counterparty risk. I agree with that part of the proposal. But why are we going to put a higher capital risk weight on a mortgage, but we're not going to raise the risk weight for a Ginnie Mae? Mortgage-backed securities have much more leverage, and they're much more dangerous, as we saw with Silicon Valley, right? It killed the bank. So I think the rationale for a lot of these changes is wrong. And I also think that, unfortunately, the Fed had an opportunity to work with the industry to really address current problems. But they keep coming back to capital. It's like the French with the Maginot Line at the beginning of World War II. They were hiding behind the fortress, and the Germans went around them. And that's exactly what's going on here. These banks, if anything, are under risk. They have too much capital. The problem is we keep pulling them out of markets like the Volcker rule, which doesn't allow the large banks to make markets around their securities holdings. That reduced liquidity in the market. I don't think that was helpful. So, you know what I mean? There's a lot of good things we could be doing with this Basel process now, and I'm hopeful that we can make some changes. I think it's going to be delayed, by the way. I think the Biden administration really miscalculated how angry everybody in the mortgage industry is over this proposal. And I mean, everyone. Why do you think we're running these ads? Nobody in America knows what Basel is. They think it's a garnish for pasta.
Well, but they do know what happened with Silicon Valley Bank. And to your point,
yes.
It's not as though it happened in a vacuum. I mean, the people at Silicon Valley Bank also made bad decisions. So how do you regulate? right? I mean, how do you regulate that? Do you increase, leaving aside mortgages for a moment, do you increase capital requirements and widen the moat of who is subject to those capital requirements?
No, Julie, you put behavioral blocks in place. This is how you do risk management, okay? You say no. So if you want to have more than 5% of total assets in mortgage-backed securities, you've got to come to us, that is to say the regulators, and show us your risk management proposal and system and procedures and everything else for managing that exposure. When you look at Silicon Valley Bank, my question is, why aren't these people in jail? Their actions were just crazy. In a falling interest rate environment, you keep buying more mortgage backs at lower and lower duration. You know, the bank was dead in 2021. So, you know, I think those are the sorts of regulatory procedures we need to focus on. Ask management to justify their asset allocation. What business are we in? Are we a hedge fund, which is what Silicon Valley looked like? Or are we a bank that serves, you know, communities with standardized financial products? That, I think, ultimately is what regulators are really weak at. They're not good at characterizing business models and understanding what the risk is given that business, right?
Well, and so, Chris, is part of the issue, too, that we need to, and I know this is not popular in some circles, do you need to actually give more resources to the regulators? Do we need to pay them better?
Yes.
Do we need to get more qualified people? You know, one could argue that that would have helped in the Silicon Valley Bank situation as well.
Most of the federal regulators are in a position to pay reasonable salaries. The Fed, FDIC, they pay quite well. The mortgage regulators, particularly Ginnie Mae, no, they need more resources. But I think overall, Julie, it's just a question of having regulators incentivized to be proactive. If you see somebody doing stupid stuff, as Senator Kennedy said today, he was great. You have to look at that clip. Then you got to stop them and say, what are you doing? You have to hold the directors and the officers of the bank responsible for their actions. And I totally agree with clawing back compensation for failed banks. We already had that power, by the way. FDIC sues everybody. But this will make it even more upfront, and I think that's appropriate. You want the directors of the bank to think about what they're doing, and that's really what it comes down to. It's risk management. It's not capital. We got plenty of capital.
And Chris, I want to get you out of here on this, kind of a broader question, just given the depth and breadth, Chris, of your knowledge about this industry. When you look at just the U.S. banking system, Chris, right now, how does it look to you? Does it look healthy, strong?
Well, the industry is insolvent on a book basis because of the Fed. The securities holdings that they have an average coupon somewhere in the threes. And if you look at the screen this afternoon, you'll see a Ginnie Mae threes trading around 82 cents on the dollar. So that's what you need to know. Can they sit with it? Yes, but a lot of banks out there are selling. They are taking the pain, and they're taking the proceeds after the loss, right? And they're buying higher coupon assets. That's the way to go. You know, remember, we're back at June yields in the bond market, so the pain is less than it was at the end of the third quarter, which was horrific. The industry was negative $1.8 trillion in terms of capital, negative. So I think that the banks that have the income to sell and restructure their balance sheet are going to be very glad that they did the next couple of years.
Chris, it is always so good to have you on the show. You always teach us something. Thank you for your time.
My pleasure. Have a great day.
You too.
Yeah.
Now here's a look at some trending tickers. First up, Sentinel-1. That stock soaring after the company reported a narrower than expected third quarter loss, raised its revenue guidance for next year. So security software provider Julie reported results. They look better than expected. Revenue jumped, looks like more than 40%. Guidance also looks solid. Some interesting comments from the company too, in saying macroeconomic headwinds. They noted that, but they said, listen, we exceeded our expectations. Also talked about AI and modern cyber warfare, how attacks are rising, and their point being that's why cybersecurity, they argue, is still top of mind for CIOs.
Yeah, some of the analysts who cover the stock talking about a positive free cash flow. That's something that is coming, that they maybe are moving their timeline up on. And something else we should mention about this company is that some of the other security company, cybersecurity companies that we've heard from have not been as positive. It's been sort of a choppy reporting season. So this one seems to stand out even more in contrast with some of those others that we've heard about.
Yeah, so moving higher today, we should point out it's up more than 60% this year. So no surprise when you kind of comb through some of the analyst notes. Some, like the team at Jefferies, for example, telling clients, listen, they would characterize this as a solid report, but in their words, valuation just looks fair here. They have a hold. Not surprising when you see a move like that.
Yeah, let's move on to Brown-Forman, the parent company of Jack Daniel's, saying net whiskey sales are down 2% year over year. The share's down by 10% here. The company coming out for its forecast for 2024, cutting its organic net sales forecast for that period of time. Second quarter results, fiscal second quarter results, earnings per share beat estimates. Net sales came in slightly light of estimates here. I was looking through the release. It's interesting because they give first half numbers for all of the booze that they sell. Whiskey sales, that 2% figure, which includes Jack Daniel's, down 2% in the first half. Ready to drink up 41%. That's obviously been a growth area. But tequila, they own El Jimador and Herradura, up about 2%. But whiskey just not doing great.
No, Dow Jones actually knowing the stock's now on track for its worst year since 1999.
Wow.
And it says, it's interesting, you mentioned the company, sort of the trends they're calling out. They did know what they see as this kind of slowdown in consumer spending. I think the money quote here was evolving global macroeconomic conditions continue to create a challenging operating environment. So another theme, of course, we've heard from a lot of retailers.
We're not drinking enough whiskey.
No. Got to move that brown liquor.
I guess so.
Finally, in the payment space, we're looking at Toast and PayPal stocks both downgraded by Bank of America. So this one, these names have gotten hit, by the way, which is interesting, but B of A doesn't see even then a good reason to move in here. So on PayPal, it's already been clobbered about, it's down about 15% this year. Analysts say here saying the company is going to be in a transition year. So they downgrade that name to neutral, move to the sidelines. They say they expect execs will try and earn street credibility, drive sustained improvement in the top line metrics, but this will likely take time, they say.
Yeah, that new CEO taking the reins, I believe, formally on January 1st here. The downgrade also coming for Toast as part of this. And this was part of a big comprehensive note looking at the whole payment space for 2024. In the case of Toast, competition is intensifying. That stock going to neutral from buy. And the company says there could be risks that could inhibit any significant move higher here. Aside from macro trends, they talk about competition from Square, from Clover, which is probably in addition to those Toast payment things, payment hardware that you see in restaurants. You see a lot of the Clover ones too. Also a company called Four. So that competitive landscape, not great for Toast in their view.
Yeah, interesting. They do like Square. If listeners are wondering, well, okay, what do they actually like? They like Square. They say Square turned a corner with that latest print. Square's up about 10% this year.
And we should mention, by the way, we are going to get a deeper dive into this payments outlook from the Bank of America analyst. That's Jason Kupferberg. We're going to talk to him on Friday and really dig into where investors should be looking in the payment space into 2024. Meanwhile, today, we're just getting started here on Yahoo Finance Live. Coming up, a slew of earnings after the bell. We'll break results for GameStop, Chewy, and C3AI and give you in-depth analysis. And the launch of a new series. It's called Goodbye or Goodbye. We're going to bring you investment recommendations for your portfolio. Oil's falling 4% today. Crude prices slipping below $70 a barrel. We'll tell you the reason for the steep decline and what you should be doing in the oil space. All that and more when Yahoo Finance comes back. Crude oil down 25% from its high of $95 a barrel in late September, dropping to a 5-month low today. Inez Ferre is here with more on today's action. What's been going on? So what's been going on, Inez?
Yeah, Julie, and you have crude oil, which today settled at its lowest since June. So you had government data that came out today from the EIA about inventories in the U.S., and total U.S. inventories came down, but their adjustment factor was the highest on record. That's sort of like to say a margin of error. So you saw crude oil today, which had opened lower. It continued with its downtrend. You have WTI down 4%. You've got Brent crude down more than 3%. Some of the selling that is happening over demand concerns. You've got Asian refineries, their production is dropping. You also have Saudi Arabia, which cut the oil that it's selling to Asia by 50 cents a barrel. So some demand concerns going forward. I do want to note that I'm just going to pull up a 12-day chart because we had that OPEC Plus decision last Thursday, that they announced some additional cuts, deepening of cuts going into 2024. But the market's really skeptical about whether those cuts were more voluntary, whether they will really go through. So we have seen that actually oil prices, since those cuts were announced last week, that oil prices are down about 6%. They've shaved off about $5 per barrel, both on WTI and also on Brent crude. You had Russian President Vladimir Putin going to UAE, going to Saudi Arabia, all OPEC members, and kind of saying, look, we are all in this together. We also had Kuwait today saying that they are supporting the production cuts. But really, there has been some heavy selling over the last several sessions, guys.
Inez Ferre, thank you so much, Inez. Appreciate it. It has been a wild year for the energy market, and in recent weeks, the market reacted to wars in Ukraine and Israel, changes in government policy, and of course, production cuts. But it's concerns about demand weighing on crude today, oil falling below $70 a barrel. And our next guest believes prices will stay low heading into 2024. Rob Thummel, Tortoise Senior Portfolio Manager, joins us with his take on the energy sector next year. So Rob, thank you for joining us. Appreciate it.
Thanks for having me.
So U.S. crude today, Rob, drops about 4%. So now we close at the lowest level, I think, since June. Help us, Rob, just understand what you see as driving those moves, and also just what you see ahead for next year.
Well, for right now, it's sentiment. So when you get this negative sentiment, it's really hard to kind of turn that ship and get it to turn to be positive. So what will change that? Well, it will be actually fundamentals. It will be inventories, global oil inventories starting to fall. How's that going to happen? Well, you're going to need the OPEC Plus members to basically cut their production. You're going to need the U.S. to not grow as much, and you're going to need demand to come back in 2024. However, we've got a long time yet before we're going to see that data show lower global oil inventory demand.
So is your base case then that oil prices stay at this level or in a range near this level for the foreseeable future?
Yeah, Julie. So the way that the reporting works is you won't actually see global oil inventories for January until March or April of next year. So you actually won't see that actual data showing global oil inventories declining until then. And so I don't see oil prices rising dramatically anytime soon, which, oh, by the way, that's not a bad thing for us as consumers. And that's also a good thing to keep inflation lower as well and maybe help keep the Federal Reserve from raising rates anymore.
Yeah, and it's interesting too, Rob, and Inez brought this up. It was just late last week. OPEC and its allies come out, they make headlines. We were talking about on this show, saying, okay, deeper production cuts are on the way, but investors just don't seem to believe them.
Yeah, no, and that's a good point, Josh. So if the cuts happen, oil inventories will actually decline, and they'll decline pretty fast because the global oil market will be undersupplied in the first quarter of 2024. Now, why is that important? Well, the first quarter is traditionally the lowest demand quarter of the year. Just seasonally, it's just a lower demand quarter. So usually the oil market is oversupplied in the first quarter and then is undersupplied for the rest of the year. In this case, you could have an undersupplied oil market. Once again, we won't be able to know that for sure until March or April. But if everybody holds and does cut as they say they're going to, we'll see oil prices rise at some point in time.
Okay, so let's talk about what all this means for the oil stocks. I was looking at the charts there earlier. energy shares in the S&P 500 have fallen quite a bit since September, just as oil has, but they haven't fallen as much, at least not collectively. So what kind of movement are we going to see commensurate with oil prices going into next year?
Yeah, so the energy sector, why invest in the energy sector right now? Commodity prices have a little bit of impact on certain areas of the sector. In particular, like Exxon and Chevron, their cash flows go down if oil prices go down, if natural gas prices go down. But the other thing is the positive, and the reason why investors should be looking at the sector is, even with these lower oil prices, the free cash flow yield of the energy sector is over 10%. The free cash flow yield of the S&P 500 is about 5%. That spread, in my opinion, is just way too wide. The energy sector is just too important, too essential for the sector to continue to trade at such a discount to the S&P 500. So what does that mean going forward? Well, I think the energy sector can continue to not only meet the S&P 500 return, but actually exceed the S&P 500 return. So it's a good place for investors to be looking to allocate capital as they look at their investment portfolios in 2024.
In terms, Rob, of where they want to allocate capital, let's give them some names to think about. One name I know you like is Williams Companies, right? Now, that stock's up about 10% this year. Not a lot of love on the street, Rob. I mean, most financial analysts, they're on the sidelines. They got the equivalent of a hold on it. Why do you like that?
So that's an energy infrastructure name. That's an area in particular we like even more. Energy infrastructure, actually, ironically, this year is actually keeping, it's up about as much as the S&P 500 or the Dow, up over 20%. Now, not energy stocks, but energy infrastructure stocks are, which is a distinct difference. Here's why I like energy infrastructure. It doesn't matter as much of what the commodity price is. It matters more of what's the volume going through the pipeline. Williams is in natural gas. It operates one of the largest natural gas pipeline networks in the U.S. If we're going to export more U.S. LNG, if we're going to produce more natural gas in the U.S., Williams is going to be involved, and their cash flows are going to go up. Their dividend's going to go up. They already have a dividend yield of 5 or 6%. So if you get 5 or 6% of your return next year already kind of locked in from your dividend, you don't have to have much capital appreciation, and you'll probably outperform what the market expectations are next year.
Yeah, and I noticed another one of your picks also is not so much oil-centric as it is I'm talking about Cheniere Energy, right? I mean, the ticker itself is LNG. Yeah. So is this in the same kind of universe, if you will?
It is, Julie, and it's been one of our favorites for a while, and it's done really well. But it still has catalysts to move higher. And what are those catalysts? Well, it continues to be the largest exporter of U.S. Liquefied natural gas, or LNG, and the U.S. is the largest LNG exporter in the entire world. So there is going to continue to be more and more demand for U.S. LNG globally, year after year after year, and Cheniere will be able to benefit from that. Oh, by the way, they also have effectively guaranteed contracts for the next 2 decades. So more than almost any company you can find in the S&P 500, I can tell you pretty much, here's what Cheniere is going to generate in terms of cash flow for the next 20 years. Now, hopefully it'll grow from there, but it's even at the baseline, it's still a really attractive free cash flow yield for the next 20 years and probably beyond.
And final pick, Rob, Energy Transfer. Why do you think that name's a buy?
It's a 9% dividend yield, and it's an investment-grade company. Where can you find an investment-grade company with a 9% dividend yield? So just from a big picture perspective, Josh, if interest rates come down, there's a lot of money right now in cash, there's a lot of money in fixed income. That's fine, you're getting some good rates there, but if interest rates come down, fixed income probably doesn't do as well. With Energy Transfer, you still get a really good dividend yield, but you also get to participate in the market upside that could potentially happen next year because of lower interest rates and because of lower inflation.
You don't see a 9% dividend yield, period, very, very often. Rob Thummel, thank you so much. It's good to see you. Appreciate it.
Thank you, Rob.
Thank you.
Up next, the premiere of a new series. It's called Goodbye or Goodbye. We're going to bring you investment recommendations for your portfolio after the break. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, sponsored by E-Trade. Our goal to help cut through that noise to navigate the best moves for your portfolio. There have been few themes noisier this year than streaming, between activist interest in Disney to the actors and writers strikes, and now the latest trend, streaming bundles. It has been an epic saga for investors. What's the best way to play it right now? I'm joined by veteran trader Stephen Sarge Guilfoyle, president of Sarge 986. Sarge, thanks so much for helping us kick off the inaugural episode of this.
The pleasure is mine.
Yeah,
Thank you for
this is
watching.
great. So let's get right to what you're considering your goodbye in the streaming space, and that is Disney. So walk us through the reasons behind this goodbye for you.
All right, well, Disney, for a change, is not really overvalued anymore. Iger's done a good job of reining in expenses. Suddenly, the stock trades at just 19 times, which is around where the S&P 500 is trading overall. Stock trades at 1.9 times last 12 months sales, 1.7 times book. So suddenly you have a valuation for Disney where it's not overvalued as it has been for most of the last 2 to 3 years.
All right, so valuation is one thing, and then the other is the big news event recently for Disney, and that has to do with activist investment. Of course, Nelson Peltz's Tryon pushing for board seats. There's some other activists nibbling at the sidelines as well. Why is this a good thing for Disney?
Who doesn't love to wake up in the morning and find out that Nelson Peltz is in one of your stocks? I mean, if you're long. I mean, it's worked for us before in Disney. It worked in Salesforce. It's worked in so many other stocks. When Nelson Peltz and his Tryon fund management guys get involved, and if they can actually get some board seats, that's even better. But even if they can just put pressure on Bob Iger and the other board members over at Disney, it's hugely positive, just in perception terms, which will put a bid under the stock and move the stock a little bit higher.
Yeah, that's something we've already been seeing. So that brings me to thing number 3, which is technicals. And really, you're a technician, right? You look at the charts, you try to figure out what they are telling you. So let's go to the chart of Disney that you've brought us. This has the 200 and the 50-day moving averages on it. You're going to draw a little bit on here.
I am.
And tell us what you're looking at. So what should we be watching?
All right. When I first took a look at Disney, all right, I first saw this kind of sloppy double bottom right here. All right, that gave me an 86 pivot. I wasn't real certain with that, all right? Now we got this little doohickey over here. This in December we started selling off, which made me recognize what this really was, which is better for alongside investors, is we have a cup. Can we make that red? Nah, whatever. A cup with handle right here. This moves the pivot up to 96.
Okay.
All right. By moving the pivot from 86 up to 96, we can move our target price from 103 up to 115. So now we have a higher ceiling. We have a little more gas while we're cooking. We feel like we're doing a little bit better technically.
Gotcha.
Now, if I fail, if my analysis here is wrong, I have an out right here at $90 at the 200-day simple moving average.
That's right here.
That's where I'll get rid of them. All right, and I'll buy them back at the 50-day, which is just below it, which is 86, which turns out to be this pivot, which was actually a pretty good resistance level before it broke. It should provide some support for us folks who want to just extract $4 of capital from the stock.
Gotcha. Now, as with anything, there's a risk, right? Even if you're looking at kind of hedging through some of the activity we're talking about. So what's the biggest risk here? If you're looking at this board ballot, what could go wrong for this call?
Well, right here, okay, if Bob Iger defeats Nelson Peltz, if somehow he is denied his proxy fight, he doesn't win any seats on the board, if somehow Bob Iger doesn't appease him in order to avoid putting him on the board, so doesn't find some kind of mutual solution, that I think would be a big negative for shareholders. And we saw that last time when they kind of had that little powwow and they got along for a couple of months. The stock took a little bit of a beating during that time, and I think it would do so once again. All right?
Okay.
Another thing that would hurt would be a deeper recession. I don't know if we're in a particularly deep recession elsewhere, which puts a higher valuation on the U.S. dollar, making it harder to travel from Europe and from Japan.
Okay, so that's your goodbye. Now let's move on to a stock, and you are long Disney, we should mention as well
Disney.
for people who are watching. Let's move on to a stock that you are short, that is your goodbye. You're saying farewell to Netflix is the one we're talking about in this case. And here too, as you're building your investment case against Netflix, you start with valuation. So how is this valued sort of on a comparable basis?
Netflix is a little more expensive than Disney overall. It trades at 29 times forward earnings, trades at 6 times sales, and 9 times book. So it's really expensive relative to Disney. All right, they posted maybe $6.05 billion worth of free cash flow over the past 12 months. Yet, over the past 3 months, they've burned $700 million worth of cash. They have not added meaningfully to their cash position in about 6 months. So they're really not, I don't think they're doing as well as that last earnings report suggested. They are priced as a growth stock. They are not a growth stock. There's a reason they were kicked out of FANG and they're not in the Magnificent Seven.
Right, and cash burn has been something that's sort of long dogged Netflix, and it sort of comes and goes in terms of concern for investors. And then finally, here you see a bearish technical setup. So once again, I'm going to call up the chart here. Here we've got the 50 and 200-day moving averages, and down here something called the relative strength index, which is a momentum indicator, which looks at whether things are oversold or overbought. So talk us through this.
Right, we see the relative strength index coming off right here.
Yeah.
Pretty sharply relative to what the stock has done. It doesn't look like the stock's taken that much of a beating, but that means it's losing a lot of strength relative to the other stocks in its neighborhood. You have a double top here over several months, which is pretty strong medicine. You also have a gap down below in October.
Make this one green.
Yeah. It never really traded there, folks. Right here we have a line chart, so it just moves with the last sales, but it never really traded between this level and this level. And what unfilled gaps do is they attract, okay? If the stock starts selling off hard, it will be drawn to that level. Now, unfilled gaps don't have to fill, but they usually do. I've been doing this for almost 40 years. They usually fill, okay? So that's what got me short the stock, seeing that gap. That's where I got excited, okay?
Okay.
So I'll give you my target price here. My target price to the downside is $354.
Okay.
Which would be about a 22% haircut from today's levels.
Okay. All right. So just like with Disney, things could go wrong. Your negative case here could go wrong also. So let's talk about that for a second here. Or maybe it's on the chart as well. What could make you wrong in this particular case?
Okay. I would swing. What I would do with my panic point, I would say, if I saw another attempt at this level.
Gotcha.
I would have to pack in and say, okay, Sarge, you lost some money on this one. Because I'm not going to chance, if it breaks through that, if it knocks on the door a third time, the door is going to open. So I would be vamoose there. All right. Otherwise, I probably will incrementally get myself out of this position so that I am flat by the time it's trading in the neighborhood of the $50 and $200-day simple moving averages.
Okay, so let's just sum up everything that we've heard from you today on this goodbye of Disney and goodbye of Netflix. You're telling investors you would buy Disney based on valuation, based on that activist campaign from Nelson Peltz, and based on those bullish technicals. And on the flip side, you're saying avoid Netflix also based on its valuation. It's expensive, the company's cash burn too high right now, and the technicals look bearish. So
I think you said it better than I can, Julie.
Thanks so much, Sarge. This has been great. Thanks for watching, all of you, our inaugural edition of Goodbye or Goodbye. We're going to be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. You can tune in tomorrow. We're going to tell you if you should still buy one of the Nasdaq 100's best performers this year. Sarge, thank you again. Really appreciate it. We'll be right back.
It's McDonald's Investor Day, the fast food restaurant company unveiling new details on its growth strategy. And here with the details is Yahoo Finance's Brooke DePalma. So, Brooke, what have you heard?
Good afternoon. Well, restaurant growth continues to be something that McDonald's is heavily investing in. We now know that it expects its total footprint to reach 50,000 by the end of 2027. That includes 900 new restaurants here in the U.S., 1,900 in its international operating markets, and 7,000 new restaurants in its international developed license market. Now, half of that 7,000 will actually be in China. And of course, more restaurants does mean higher spending for McDonald's. They plan now for 2024 that they're going to spend $2.5 billion in capital expenditures. That's higher than previously expected. Now, beyond just restaurant growth, the company also gave some insight on those changes to its burger that it announced earlier this year, like softer buns, more melted cheese, more Big Mac sauce. That is going to be in nearly all markets by 2026. Also, that McCrispy that got so much buzz during the chicken sandwich phenomenon, that is now going to reach all markets by the end of 2025. We also might see, and I'm happy about this one, an expansion into wraps and tenders. I missed that snack wrap, but this will be a new iteration of the McCrispy wrap. And one big announcement also from McDonald's is that they are partnering with Google Cloud. And so we can expect to see much more on Gen AI, how it's using it inside its restaurants to ultimately become more efficient and also interact with customers.
Gen AI, okay, all right. So let's talk about the, leaving that aside for a moment, let's talk about the overseas market for McDonald's for a minute, because what potential are they seeing outside of the U.S.?
Yeah, well, similar to Starbucks, McDonald's is also heavily investing in China. Like I said before, nearly half of that 7,000 store expansion for its international developed license markets will be in China. And CEO Chris Kempczinski said that you learn a lot, essentially, when you're opening over 1,000 stores per year in China. And when I spoke with him over the phone, he weighed in on what makes him so optimistic about the China market. Take a listen.
As we look at China, we think there's still margin potential in that market to get closer to what we would see as our sort of developed market margins. So you take a ton of new restaurants with great comp growth and improving margins, and it adds up to, in our view, a very optimistic outlook for China.
And by 2028, McDonald's does plan to reach 10,000 restaurants in China. Right now, they have about 6,000 restaurants currently. And to bring things back here in the U.S., now you guys may have not heard about this, but it is a viral phenomenon that hit TikTok over the weekend. They are testing a small restaurant concept called the Cosmic. That's a play on its 1980s character. They're intending to pick up. You don't know about the Cosmic? You gotta read out, Julie.
Julie, you don't know the Cosmic?
Unlike someone at this table, I was alive in the 1980s. I don't remember anything named Cosmic.
But this new restaurant concept, there's only going to be 10 locations in this pilot over the next year. So they'll roll out the first half. They're going to be a year-long test. One's in near Chicago. The other 9 are in Texas. This is intended to pick up that 3 p.m. slump. So they're going to be doubling down on creative beverages, cold brews, as well as these smaller sort of grab-and-go type of items.
Starbucks.
Huh?
Right? I mean, that sounds like
it also reminds me of a Dutch Bros. It has those Rebel drinks. So it'll be interesting to see the way this plays out. But Chris Kempczinski, the CEO at McDonald's, said this is just a test. Because after, once you guys know about this now, you'll see it all over your social media.
I gotta look up what Cosmic was in the 80s. I have no recollection.
It's like an alien type character.
Do you have any recollection of that?
This is. You see, we're not on TikTok. This is what we miss.
Well, we lived in the 1980s. I don't remember this.
Well, the reference I'm not getting either.
Well, there's been lots of buzz about this online, and so with these new restaurant concepts, I mean, people are excited. And who doesn't love a quick coffee?
It's a good thing you're here, Brooke. Just tell us what we're missing.
Right?
We'll all have to take a trip to Chicago or Texas.
Obviously, or Texas. Brooke DePalma, thanks a lot. Really appreciate it. Well, let's get to our call of the day here. Shares of Deere edging higher today as the company raises its quarterly dividend to $1.47. That's a 12-cent increase from the previous level. The stock has been struggling this year. It's down around 14%. It's significantly underperforming the S&P 500. Shares in particular plummeted in November after Deere's profit outlook disappointed the street. And many investors are concerned about slowing demand for farming equipment broadly. One analyst does see upside, though. Oppenheimer naming Deere a top pick and a, quote, best-in-class through cycle pick. Here with more is the analyst who made that call. It's Kristen Owen, Oppenheimer Executive Director and Senior Analyst. Kristen, thanks a lot for being here. You made this pick as part of your overall look at the industry, sort of ag tech, farm equipment industry going into next year. Just to take a step back for a moment, Where are we in that cycle? And for people who don't follow the industry closely, what do these kind of farming cycles look like for a company like Deere?
It's a great question, and it really frames out why we made the call that we did this morning. Now that we have a little bit of visibility on where we are in the cycle, having really earned very strong over the last 2 to 3 years, saw a good replacement cycle for farm equipment that's been supported by healthy commodities prices. Now that those commodities prices have started to come down, we're seeing that demand for farm equipment has also been sated. And so we're looking at this now with Deere having guided 2 weeks ago, saying, okay, we're seeing the first step down in this cycle. And how we've tried to frame this is relative to the last major ag cycle. So if we look back 2013 to 2016, that was 3 years down that we saw. And that's how we're assessing our picks now, is trying to take a look at that 3-year cycle and saying, where do we go from here? And is there upside on the shares from here now that we have that cycle clarity?
And this ag equipment down cycle, Kristen, though, part of your thesis here is it's not going to be, though, as severe as the last cycle that we saw 2013 and 2016. Why is that? What are the differences?
There are a number of differences that we could point to, but the biggest one that we see is in the last cycle, that 2013 to 2016 down cycle. 2012, 2013 were years 6 and 7 of overproducing more than the average replacement amount of tractors. So you had this shift in the trade-in ladder that meant a lot of people who would normally buy a secondhand tractor were buying tractors in the new market. That put too many tractors out there, too many tractors that then ended up in the used equipment space, and we needed to work through some of that excess inventory. Fast forward to this cycle, and we've really only, quote unquote, overproduced for 2 to 3 years. So we haven't saturated the market to the same extent that we did last cycle. So we just have less excess to work through. We also think some of the crises that have driven this last cycle, commodities prices, geopolitics, COVID, supply chain, these crises are maybe not repeating in the same exact way, but they aren't changing. And with climate variability, they're likely to see more mini cycles that we think keep this current cycle from being less steep than the prior.
Okay, so bring it back to Deere for us then. If this cycle is not going to be quite as bad as past cycles, why is Deere maybe going to do better than its competitors through this?
Well, so Deere has one thing that its competitors do not have in sort of this cycle over cycle analysis, and that is that they have actually seen some multiple expansion by deriving better, higher through cycle earnings. So we've actually seen that their multiple has expanded 2 to 3 times this cycle versus last. And we think that history can be a good blueprint for that repeating this time around. And Deere's the only among the 3 that has actually enjoyed that multiple expansion. So we think because they're doing these things like integrating more technology, artificial intelligence, driving productivity for farmers, they're actually getting paid for that in the market. And at this level where the stock is today, there's actually a tremendous amount of upside that we could see from here.
And Kristen, you mentioned where the stock is today. It was down about 15% this year, Kristen. What are the specific kind of key catalysts you think could move this stock higher? Are there some dates on the calendar that investors should have?
This cycle clarity was certainly one of the catalysts that we were looking for. A lot of the analysts on the street were sort of mixed in terms of their views on where we were in the cycle. This is going to take probably a quarter or 2 to shake out before we all get our models tuned up. In the meantime, we're looking for certain performance metrics like margin protection. How are they integrating more data about engaged acres, driving that technology performance? So these are the kind of KPIs that we're looking for over the near term that can help demonstrate that Deere is really moving the ball forward in terms of pushing their through cycle margins higher.
And you mentioned, of course, that there are 3 big players in this industry. You've got Deere, you've got AGCO, you've got CNHI. You alluded to technology, and I know that has been a big theme that all of them have been talking about, right? Technological innovation when it comes to what they're trying to offer farmers. Is Deere in a better position than the others? Are they kind of all in the same place? And how much of a value add are farmers going to be seeing that as we go through this sort of down cycle?
Yeah. Without question, Deere is the technology leader. They were the first to connect their equipment, and now they're the first to put edge intelligence on that equipment. Now, the onus on Deere is to continue to innovate through this down cycle so that they can maintain that leadership. In the meantime, what we're really excited about is a name like AGCO, who has a little bit of catching up to do in that technology space. They recently announced a major joint venture agreement with Trimble that helps give them a leg up in some of this technology. And it's part of why the way that we've positioned these stocks is Deere is a best in class through cycle, but AGCO has some of the most exciting catalysts over the next 12 to 18 months. Now, you asked about farmers sharing in that productivity. As we move back to normalization in this market, productivity becomes that much more important. It comes down to cost of operations, and technology is one of those things that can help make or break your margin when you're seeing compression on the commodity side.
Kristen, Owen, thank you so much today for joining us, Kristen. We appreciate it. And coming up, closing bell on Wall Street. We're checking in on the latest market moves, the top trending tickers. Stay tuned.
We're coming up on the closing bell on Wall Street, so let's do a quick check of what we've been seeing throughout the session, Josh. And as we were talking about earlier, not a whole lot of movement. We have seen things accelerate a bit to the downside as we've gone head towards the closing bell. The Nasdaq now set up for a decline of 0.6%. So a considerably bigger move than we were seeing just a little while ago. And there you hear the closing bell on Wall Street here on this Wednesday. We've kind of been drifting here after seeing a pretty big upsurge in stocks. The narrative has kind of changed to, did markets get ahead of themselves? Are we pricing appropriately the outlook for the Fed to cut rates next year? And so with that debate has brought a little more choppiness into the market.
And maybe, listen, only 2 days out from the big jobs report as well, so maybe not too surprising. You see some treading water here. Some traders, investors don't want to step in front of that.
Yeah, it definitely looks that way. At the end of the day here, energy still the worst performer, as we talked about earlier, down about 1.7% on the day, along with oil prices pushing below $70 a barrel. Tech stocks also seeing some weakness, along with the financials. We had those big bank CEOs testifying on Capitol Hill that if Basel III goes into effect, that's going to be detrimental to them. On the plus side today, utilities, the big winner. Remember, we were talking about, I had you guess it before. You didn't guess that's the worst performing group this year. So there's some rotation back into the utility stocks.
All right, now let's get to some trending tickers as well here. We're going to start with shares of work management software company Asana plummeting. Despite an earnings beat, investors concerned larger macro issues will continue to slow the company's growth. And you can see there, rough day Asana, if you're bullish on that name, down nearly 7 to 17%. Brent Bracelin over at Piper, analyst I like a lot, smart guy. And Brent is underweight that name, so equivalent of a sell. Talks about what he sees as eroding fundamentals. Profitability remains elusive, he said, increasing operating expensive. And then I think really the money line to his clients, the growth outlook suggests that challenges could persist, he said, into next year's price target 16.
Yeah, that's something that Brent Thill had talked about as well. So when we're looking out to next year, bookings is something, billings, sort of those forward indicators is something a lot of analysts were pointing to for this company. The stock, by the way, is up considerably this year, more than 40%. So the declines that we're seeing today is on the back of that, although that 2-year chart looks a lot uglier than that. The name of this company always cracks me up. And asana is a yoga pose.
I did not know that.
So I assume that's where it comes from.
No.
Which, of course,
you learn something every day next to Julie Hyman.
Software and applications and yoga hand in hand, of course.
Well, now I'm feeling kind of calm about it. I was worried about this name,
but now you feel much
more centered.
Well, let's talk about another stock. Maybe it's going to make, I don't know, we'll see what mood it elicits. Robinhood, that stock is up 7% today. Now, apparently, analysts had a dinner with management, and a lot of them coming out with some positive comments on the back of that. By the way, we talked to Devin Ryan yesterday of JMP Citizen Securities. He already was pretty positive on Robinhood as well. Dan Dolev, who is a smart fintech analyst and both of us follow over at Mizuho, said he was happy to hear about the firm's crypto share gains. That's something we talked about yesterday, that they saw a 75% increase in crypto volumes in November from October. So the surge we've seen in the stock lately has been pretty incredible for Robinhood.
Yeah, it's been a nice pop. Of course, you're still down very hard from that August 2021 high there for sure. But to your point, they had this dinner, and financial analysts, I don't know, they ate well, maybe they drank well, they liked what they heard. They're telling clients. Citi's saying, to your same point, Julie, they were telling clients today, yes, they are more constructive on the company's growth prospects than we have been in some time, though, of course, they are still neutral, so on the sidelines. But you did see some positive commentary out of this one.
Yeah, and just one more thing I wanted to mention about the recent surge that we have seen. 11 of the past 13 sessions for Robinhood have seen increases in the price. And so that means an about 40% surge in that period of time just in the past few weeks. So it's been an impressive move. Even before, obviously, all these analysts came in and
even before the dinner
had a nosh together.
Wish I was at that dinner. All right, finally here, British American Tobacco. Let's check that one out. Fallen today after announcing it's writing down some of its U.S. cigarette brands by about $31 billion. So that's your headline. Of course, think of this brand. You know, that's the maker of Lucky Strikes, for example. So taking a non-cash impairment charge, it looks like, of about It's called $32 billion. Also says it's now looking for 2023 organic revenue growth. They're now saying at the low end of its 3 to 5% forecast. Stock's down about 30% this year now, which is a whole lot worse than Philip Morris, name behind Marlboro.
I mean, I think what investors are taking away from this, as they have been, is that this is a structurally and fundamentally challenged market. Whether you're talking about traditional cigarettes, which we already knew, but also looking at some of the newer products within this area, as the cigarette makers have really struggled to come out with new things to appeal to consumers. And indeed, Morgan Stanley analysts are saying the midterm guidance is disappointing. They highlight challenges in the U.S. cigarette market, but also increased competition in things like vapes and heated tobacco and e-cigs. And British America in particular, some of the analysts are saying, is a little bit behind the ball compared to some of its rivals when it comes to some of these newer products. But really, it seems like there's some bigger questions about the industry overall.
Yeah, for sure. Company does also make, you were talking about some alternatives.
Yeah.
I mean, the company does make, for example, nicotine pouches. And there it was interesting. It said its alternative products business is expected to actually break even in 2023, be profitable in 2024. I think it speaks to what you're talking about there, these trends of where smokers are headed.
Yes, or not in some cases. Yeah, exactly. All right, moving on. Let's talk about billionaire Brad Jacobs, founder of 5 publicly traded companies like freight transit company XPO and the world's largest equipment rental company, United Rentals. Well, Brad's back at it again with a new investment vehicle. Alongside minority co-investors, he's going to funnel $1 billion into software firm Silver Sun Technologies. That cash will then be used for acquisitions at a later date, and Jacobs will become the chairman and CEO of Silver Sun. He's here with us right now. He's still chairman of XPO. It's great to see you, Brad. You also, by the way, in your spare time, just wrote a book, How to Make a Few $1 billion.
Thank you for reading it.
Yeah, sure. So first I have to ask you, because we have talked, and I knew that you were looking sort of for your next chapter.
Chapter?
I wasn't even doing that on purpose. So why structure it in this particular way? So it's interesting because you are buying this company effectively, but you're going to get rid of what it does now and make it do whatever you want it to do. But why do this versus, say, a SPAC or another kind of investment vehicle?
I don't like SPACs. From the point of view of, I don't know that there's a real fair alignment between the promoter, so to speak, and the investors. They don't put any money in usually, and they get 20% off the top. What I'm doing is something very different. We're actually putting our money where our mouth is. We're putting $1 billion into a very small cap company. It was $15 or $20 million market cap as of a few days ago. And then we're going to spin back that company to its legacy shareholders. We're going to give them a little dividend, $2.5 million. We're going to give them a little taste of the new company, like less than 0.5%. Then we'll be left with a publicly traded company with $1 billion of cash in it, and we're off to the races.
And how do you pick this one? I mean, could it almost have been any company? I mean, what criteria then, because you're getting rid of that fundamental business?
I like the fact that it was small, so we had less dilution. You remember with XPO, we did a similar concept. We had a company called Express One, which is where the ticker XP, Express One, came from. And we put $150 million into it. We did a pipe into it. And we got about 70% of it. We had a lot of dilution. 30% made billions of dollars on our backs. So this time, we're going to have over 99% of the company from the beginning. So it's small size actually was a benefit to us. Okay,
so businesses you've done so far, oil brokerage, waste management, logistics, and now equipment rental. A small one that I forgot. So what's this one going to be?
I'm not going to tell you yet, but I will describe in general what I've been looking for over a year and what I'm soon going to announce, but not today. I look for large industries. All the industries you just mentioned are ones that are hundreds of billions of dollars in size, some actually even over $1 trillion. Why? Because I want to create a company that's tens of billions of revenue. So I can't go to an industry that's only tens of billions of revenue, or else that's not realistic. So I look for large industries, ones where there's lots of companies to buy, where I can do acquisitions, and where it makes sense to do acquisitions. In other words, where 1 + 1 + 1 equals more than 3. And I have found an industry that I'll announce soon that meets those requirements.
So in looking through this book and in learning a little bit about your thought process, it is not a traditional thought process. I think it's.
Well, I'll take that as a compliment, Julie.
And I mean it as one because
you have traditional thought process, you have traditional results.
Exactly. So as you're thinking about what industry you want to get into, how have you been trying to find it? What are the sort of types of methods like you describe in the book that you're using?
I've looked at so many industries in the last year. It's been fun, very intellectually stimulating, and I've learned tons and tons about many, many industries. But I ruled out almost all of them because they didn't check all the boxes I was looking for. Either they were not terribly profitable industries, or they were way overvalued, in my humble opinion, or acquisition wasn't really the proper way to go for that industry, or there was no way to apply technology to improve the business, or I couldn't bring some of the management techniques that have worked so well at United Rentals and XPO and United Waste. I couldn't apply it there. So I studied a bunch of stuff, but crossed almost all of them out. But I did find one that I liked.
Well, and it's interesting to hear you describe this because with the passing of Charlie Munger recently, I was struck by his commentary that what he did got more and more difficult as time went on, especially because everything he said was overvalued at a certain point. So now that you've been at this a little while, is it a lot harder now to find something than it was?
So two things there. One is it's a lot easier to do the business plan now because I've made every mistake in the book and I've learned from them all. And I've learned what worked and what made all these companies very, very successful. In terms of finding something, there's always something out there. I mean, you're not looking for everything, you're looking for one thing. So it's no harder now than it was in the past. And in some ways it's easier because I couldn't have looked at hundreds and hundreds of deal flow like I did in the last year, 15 years ago. The world wasn't as small and my relationships weren't as strong either.
So, the How to Make a Few $1 Billion is the title of the book, which is, a little bit funny, obviously, to a certain extent. But, you have done this. Other people have done this. What is sort of the characteristic of people who are able to build these kinds of businesses and make a few $1 billion? What really stands out to you that makes those people different?
Many things, but if I had to just pick one, I would say it's the way people think. Thinking in a way that problems are friends and not enemies. Thinking in a way where you can rearrange your brain to stay cool in the midst of all the incoming missiles that you get. Figuring out ways to think very big, very, very, very big, and moving extremely fast. Those kind of, it's really psychological, I would say, was the main thing, is psychological differences that in some ways are abnormal, but in some ways are very helpful.
Yeah, and I think that was the thing that struck me about the book thus far is that whole think different, right? It struck me how much you were striving to do just that.
Yeah.
So, Brad, thanks for coming in. Obviously, we're going to keep in touch and learn what this industry is that you're going to be getting into.
Great to see you.
Appreciate it. Josh?
Campbell's reporting its Q1 2024 earnings today. The soup giant beating the street's earnings expectations as net sales saw a decline. Campbell's also reaffirming its full-year fiscal guidance and expecting to close on its acquisition of Sovos Brands next year. Yahoo Finance's Brian Sozzi had the chance to speak on all this with Campbell's Soup Company CEO Mark Klaus. Take a listen.
I think part of what was quite positive in the quarter for us was the consistency and the alignment with our expectations. Because in many ways, I think that signals a grasp over what is going on in a relatively dynamic consumer environment. So I think the first, kind of takeaway for me from the quarter was, okay, good news. Even where there may be places where there's pressure, we're feeling good that we've got a good handle on what's going on. And then therefore the plans and the program and even the outlook, we feel very consistent. That's why we affirmed the full year today. I do think within the quarter, though, there were certainly some things that were positive and some challenges. I would say that one of the things I reminded people today quite a bit about was the fact that we were lapping the best quarter certainly I had since I've been here of a 15% growth rate, and it was a monster quarter as it related to soup in particular. So the fact that we were down 1% on sales after cycling 15 growth and a 2-year run rate of 7, puts it in a little bit of different context. I do think volumes, though, as we continue to have a fair amount of pricing in our numbers right now, are still a bit under strain. And I think it was one of the reasons why I highlighted units and volume improvement in the Thanksgiving period over these last 4 weeks, because I know that's something that as we progress through the year, that pricing wanes as far as contribution. We are anticipating volumes to improve. Not a hockey stick, but certainly a better stabilization and improvement.
Mark, hang with me on this next question. So before this interview, I went to the Yahoo Finance homepage, and you can clearly see gold prices at a near record high. Crypto is back above 42,000. Stocks are still at record highs. Is that, I guess, euphoria in certain markets or investing in stocks, gold, but whatever it is that euphoria being seen in consumers? I'm trying to figure out is what we're seeing in markets is justified from the consumer in this country.
Yeah, you know what's interesting about that? I think part of what makes this moment complicated, and I would say to a certain degree unfortunate, is you are seeing some bifurcation in consumer attitudes and behaviors. And unfortunately, I think in particular, the lower income households are really feeling pressure right now. And even though in the backdrop of some of the broader macroeconomic variables that may look a little bit more encouraging, I think in that particular consumer demographic, you're experiencing reductions in SNAP benefits. You're likely experiencing higher interest rates as it relates to debt or how it's relating to your mortgage, housing costs in general, higher. You might be paying your education loan as well. And so as we think about servicing different contexts of consumers, it's really important that we maintain that affordability and that access, and that we're providing solutions that for that lower income household will really benefit from it. And it's even more pronounced, I think, as a responsibility as we walk into this holiday period. Conversely, our more middle to upper income households are continuing to be very resilient. A lot of our premium brands are actually doing very, very well. And so you do see a little bit of this segregation. And I think that's unfortunately causing a little bit of this tension and narrative between how do we really feel about the economy right now.
And Mark, this consumer pressure that you're talking about, is that seen through the prism of the broth category? Broth, for no pun intended, was warm. It was hot. It was a hot category. Are people buying broth, using it to make meals that last an entire week instead of going out and buying a can of condensed soup? That's still happening.
Yeah, that's very much still happening. I think consumers are really focused on trying to stretch those dollars, and in doing so, really stretch the meal occasion. And so we see products like our broth business, our condensed cooking, like cream of mushroom, cream of chicken, pasta sauces. These businesses are highly relevant right now as consumers are trying to do that. And conversely, we're seeing a bit more pressure on single serve, like our canned soup or like chunky soup, for example.
Certainly caught the attention, I think, of investors, reaffirming your outlook. What changes in the back half of your fiscal year that you're growing again?
Yeah, I mean, the first thing I'd just say, Brian, is I think part of what we were able to help people understand today is that it's not as if we're anticipating this radical change in consumer behavior or landscape. What really is at work is first and foremost this foundation of what we're comparing to. You know, as I pointed out in the first quarter, although down 1%, we were cycling 15% growth. And that mid-teen growth rate was true for Q1 and Q2. As we get to the back half, that will drop significantly as pricing wanes. And so therefore, the comps that we're going to be running against in Q3 and Q4 are far more manageable. And thus then, even in a world where we're performing at a similar dynamic or level as we are now, already you're going to have improvement. I think further to that, though, I would say that I feel better about our innovation funnel this year. I feel great about our marketing. You know, we've got big product.
You have Goldfish Crisp, right?
Yeah, right behind me. I mean, how did that happen?
Not sure.
But a big move for us, and another big extension and innovation on Goldfish. And I think the combination of the easier comps with a very strong and robust plan gives us great confidence that we can see what is relatively modest improvement and stabilization as we get to the back half of the year.
Mark, maybe you can help us understand this one. Why hasn't this Rao's deal closed yet? I know there was some time, but you mean to tell me that lawmakers really have problems with Campbell's Soup buying a pasta sauce company?
Well, you know, we all have to follow the process and the rules that are laid out, and so that's exactly what we're doing. I think it's been a very constructive conversation. a very collaborative process. We are certainly working hard to fulfill the requests of the FTC. And again, we feel great about this deal. We feel terrific on the outlook for closing. And, I think our focus is let's just get done what we need to get done and keep moving.
That was Campbell's CEO Mark Klaus on the latest quarter. And looking ahead here, be sure to tune in tomorrow for Yahoo Finance's latest installment of Lead This Way, where we'll get a closer look at Mark Klaus's leadership of the food company. And coming up, Bitcoin is rallying as investors await approval of the first spot Bitcoin ETFs. Our next guest runs a company eagerly awaiting those approvals. That conversation after the break.
One of the big movers of the week is Bitcoin, the cryptocurrency surging as of late, now trading near $44,000. That's its highest level in nearly 2 years. One of the drivers of the recent rally has been optimism over regulatory approval for a spot Bitcoin ETF. Our next guest runs one of the companies waiting to hear from the Securities and Exchange Commission. Joining us now, Michael Sonnenschein, Grayscale CEO. Good to see you, Michael. Thanks for coming in.
It's great to be here.
So I guess let's start with price here. What do you make of this latest surge? A lot of it does seem to be over anticipation that you guys and others are going to get approvals. Is the market setting itself up for disappointment here?
Well, there's been a lot of optimism in the market. I think a lot of that started earlier this year when our court case came to fruition. We won against the SEC, vacated that denial order of GBTC to uplist as a spot Bitcoin ETF. I think since that time, the macro environment, because Bitcoin means different things to different folks, you have seen some investors flocking to Bitcoin, flocking to gold in a rising rate environment as an inflation hedge for their portfolios. But maybe now, as we're kind of turning the chapter into the new year, we're seeing the Fed maybe going to start cutting rates. You could see us move into a more risk-on environment and some investors allocating to Bitcoin thinking more about it as a technology investment or a risk asset.
And Michael, as you said, Bitcoin means different things to different folks. J.P. Morgan CEO Jamie Dimon has a view. You won't be surprised he didn't mince words. At that bank hearing on Capitol Hill today, he spoke about it. Let's take a listen to that and get your reaction.
He's been deeply opposed to crypto, Bitcoin, et cetera. You pointed out the only true use case for it is criminals drug traffickers, anti-money laundering, tax avoidance, and that is a use case because it is somewhat anonymous, not fully, and because you can move money instantaneously, and because it doesn't go through, as you mentioned, all these systems have built up over many years, know your customer, sanctions, OFAC, they can bypass all of that. If I was the government, I'd close it down.
So listen, I mean, in some sense, Michael, Jamie Dimon kind of echoing some comments he's made in the past. He's, been skeptical. He doesn't mince words, but let's get your response to his response there.
Well, listen, I think every executive, particularly in the financial services space, is going to have their own opinions on new technologies and whether that's crypto or Bitcoin specifically. But if you take a big step back, there is no question that this asset class is here to stay, that investor interest in this asset class is only growing, and it is these exact types of entities, these legacy institutions, these banks, that are already well underway on evolving their business models to account for these new technologies. So regardless of the opinions that some of these executives may have, these banks and these large institutions have to position themselves for the modern day investor, and that includes adopting new technologies like crypto.
And I want to ask specifically also about something else he alluded to that Elizabeth Warren asked all of the bank CEOs about. She was really talking about anti-money laundering, new regulations that she wants put in place that crypto would be more subject to. And all of the bank CEOs said they were in favor of that too. Does that make sense to you? Is it realistic even to have the crypto industry be subject to those kinds of regulations?
I think it absolutely is. I think one of the best pieces about crypto is the underlying blockchain technology that allows us to monitor transactions taking place, unlike in cash transactions where those are not traceable between individuals. And so there are fantastic businesses out there that are monitoring activities, the on-ramps, the off-ramps from crypto, from Bitcoin specifically. And that is the exact type of regulation that I think the crypto industry not only wants, but needs.
And Michael, if and when the SEC does greenlight these spot Bitcoin ETFs, I'm just curious where you think the demand comes from, Michael. Do you think it's going to be, is it retail investors, is it institutional investors, is it RIAs? What do you think?
Well, by and large, the middle part of the investment community, right, the RIAs, the independent broker-dealers, the wirehouses, they have to use products that they need on their product shelves in order to access that and give that to their clients. And by and large, they've not been participating in the crypto ecosystem because spot Bitcoin ETFs haven't been approved. And so what we are seeing is a lot of demand coming out of that segment of the market. There's over $30 trillion of advised wealth just here in the US alone. And so when you look at products that are seeking to come to market as a spot Bitcoin ETF, like Grayscale Bitcoin Trust, GBTC, you can see how having the simplicity, the tax efficiency of the ETF wrapper could really help advisors and their clients access the opportunity of crypto.
What kind of conversations have you been having with the SEC as of late? What kind of questions have you been getting from them? How are you feeling?
We're feeling optimistic. We have been actively engaging with the SEC. The questions that we're getting from them signal to us that they want to engage on this issue, that they're eager to make progress on this issue. Of course, your next question is going to be, well, when? What's the timeline look like? Timelines have not been shared, but this is the #1 priority for the Grayscale team, and we remain optimistic that we will be uplisting GBTC to the New York Stock Exchange.
There's one more thing I want to ask you about, which is and I wrote about it in the Yahoo Finance morning brief today, which is with price moving upward in Bitcoin, you got a lot of the voices that we haven't heard from in a while who have been reemerging. And a lot of the rhetoric around Bitcoin is almost religious in some circles, right? It's the answer to everything. It solves everything. You got to be in a blah, 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 blah. How do you feel about those voices? And for most people, what role should a Bitcoin investment play?
I think that even though we are over a decade into the development of Bitcoin, that one use case that I firmly believe has solidified itself is as a digital gold, a digital store of value. We may see further adoption of Bitcoin as a payment rail or remittance rail, but certainly as investors are thinking about it, engaging with it, that it is very likely to be received as a gold, just better positioned for the digitized age we live in, more portable, more divisible, and verifiably scarce.
All right, Michael, thank you so much for joining us today. Appreciate it.
Great to be here.
And coming up, need some personal finance tips, investing help? Personal finance guru Vivian Tu, founder of Your Rich BFF, joins us next.
She got her start working on Wall Street before carving her path in the media space. Vivian, too, took her money knowledge to social media, building her platform known as Your Rich BFF, which provides a guide to financial literacy.
Everybody loves talking about high yield savings accounts, but no one ever actually shows you how to get one. So I'm going to. I'm going to let you in on a secret to crush your credit card debt fast. Here's a little explainer on how to find the index funds with the lowest fees. Everyone says you should invest, but no one explains to you how to do it. So I will. If you want more tips to live your best financial life, I'm Vivian, your rich BFF and your favorite Wall Street girly, and I'm giving you the secrets.
And now she's ready to show her financial mentoring skills on the page in her new upcoming book, Rich AF. Joining us now is the personal finance guru herself, Vivian Tu, founder of Your Rich BFF. Thanks so much for being here, Vivian. So obviously you have a lot of media present, content creator presence out there. Now getting into a new kind of content in a book form. I'm just curious, first of all, why you decided to go the book route in addition to all of the other content that you're putting out there.
It actually came just because the BFFs were asking for a book. They were saying things like, hey, your videos are so helpful. They're 60-second snippets of little tips and tricks. But is there a place where I can find everything I need to do, step by step, if I want to be good with my money, if I want to be more financially stable and feel more confident and capable in my financial journey? I want to go from A to Z, and I thought the easiest way to do this would be to write a book so that people could read it from page 1 to the very last page.
And so, Vivian, let's get into some of these tips and tricks here for our listeners. In terms of budgeting, Vivian, you talk about the 50-30-20 rule. Walk our audience through what that means.
Yeah, I love the 50-30-20 method because it is one of the easiest budgeting strategies. Essentially what you do is you see what you are taking home in terms of cash, and then you split it up. 50% goes towards needs, so things like your rent payment or groceries. 30% goes to wants, so that's getting your nails done or going to grab a drink with friends. And 20% goes to all of your financial setup for the future, so saving, debt pay down, and investing.
Savings is such an interesting topic for me, right? Because it is so hard for so many people to do. What's your number one tip when it comes to advising people how to save, how much to save, how to think about saving?
Yeah, so I think the easiest thing people can do when it comes to saving is to make a quick switch from a traditional savings account to a high yield savings account. This is so easy because high yield savings accounts are offered through FDIC insured institutions, very similar to a traditional bank. However, instead of giving you, I believe the national average right now is 0.46% in interest, a high yield savings account will give you somewhere between 4 to 5% right now in annual percentage yield.
And Vivian, on that same topic of savings, you talk about the 7-day rule. Explain that.
Yeah, this is a little bit of mental gymnastics that I use to help make myself a smarter shopper, especially during the holidays where words like deal, coupon, discount are everywhere. Essentially, if there's something that I want, I go and I put it into my digital cart, and then I just exit out of the tab and I go somewhere else and I wait for 7 days. In 7 days, if I still really want that thing or that service, I can go back and get it. But in 7 days, if I've totally forgotten about it, I probably didn't need it or want it that bad to begin with.
I actually, even though I would really have a hard time with that, I kind of love that suggestion. Vivian, I want to take a step back as well and talk about the idea of the rich BFF and sort of how to get rich, if you will. The tips that you're offering, are you sort of focused on, you know, getting rich per se? Is it focused on wealth building? How do you think of kind of the services that and the advice that you're offering to people?
Yeah, I think it has a lot to do with wealth building, but also just setting yourself up for financial security and demanding the most that you possibly can out of life and your money. It has a lot to do with making sure that you're negotiating your worth at work and your career effectively every single year, asking for that raise. It has a lot to do with, hey, maybe delay gratification for a short period of time so that today you can take care of future you through investing, but also the simple day-to-day blocking and tackling like budgeting and saving.
And Vivian, on investing, when I was first starting out, first started working and was able to invest, this is a long time ago, I remember getting the advice, Vivian, you know what, just dollar cost average into the most boring, plain vanilla, cheap index funds you can find, max out the 401k. I remember being taught this, right? This is by business reporters and the editors who were teaching me this. Is that still good advice, Vivian, to the youngins who are listening right now?
I absolutely believe that is still really great advice. I think these days people want to have a get-rich-quick scheme and something that's flashy and exciting because that's what we've seen in pop culture and in the movies. But investing, ideally, if you're doing it right, is actually pretty boring. It's slow and steady, and that is how you're going to actually be able to effectively build wealth over time. And of course, like you mentioned, dollar cost averaging just helps you weather any sort of, highs and lows and dips, but also taking advantage of your 401k. A lot of employers these days are offering that employer match, so make sure you are not leaving any free money on that table.
Yeah, definitely. So when it comes to your BFFs, as you call them, the folks who are watching your content, what is the stuff that they want? What advice do they sort of want the most? Where do they feel like the biggest gaps in their knowledge is?
I think most importantly is that they want advice and information that's going to impact their day-to-day lives, stuff that they didn't necessarily learn about in school. So I would say the hottest topics right now are how to tackle debt, in particular student loan debt, how to buy a home, how to invest properly instead of just trying to buy the most recent, crypto phenomenon or meme stock. People really do want to be smart and responsible with their decision making, and I'm happy to help.
Your Rich BFF founder, Vivian, too. Vivian, thank you so much. Appreciate your time today.
Thank you so much.
And coming up, Lamborghini CEO Stefan Winkelmann joins the program as the company marks 60 years on the road. It's coming up next.
Italian luxury automaker Lamborghini making waves in its 60th year here on the road, capping off a huge year with the debut of a special version of its new Revuelto supercar, the Opera Unica, at Miami's Art Basel. It comes as the company isn't breaking sales records across the globe. Joining me now is from Miami is Lamborghini CEO Stefan Winkelmann, and of course Josh Lipton here with me as well. Stefan, talk to me about the Opera Unica. It's a car made for the glitz and glamour of Miami and also the Art Basel scene, isn't it?
Yes, the idea was born because we are in our 60th anniversary year. So the year 2023 is very important for us. And the most important thing we did for the 2023 year was the launch of the Revuelto. And coming to the Art Basel here in Miami, we wanted to have something really special. So we thought about putting together the 60th anniversary with the Revuelto. And we decided to do one Opera Unica based on the silhouette we use to celebrate the 60th anniversary. So we asked our Centro Stile, so our design center, and our people who do the individualization to create this wonderful car. We call it Opera Unica, and it took more than 700 hours of work to create this outstanding car.
Well, Stefan, it's beautiful. I have a bigger kind of 30,000-foot view question for you as well, Stefan. Though I want to get your take on the consumer. You obviously have some unique insight there, especially, of course, the high-end consumer. From your point of view right now, Stefan, how is that consumer holding up? Does that consumer still look healthy, strong, resilient?
But after COVID, it was very difficult to read the market because our prognosis were lower than the reality. Even when the Ukraine war started, the inflation, high interest rates, all this was not affecting, the run on the market of our cars. And I have to say that it's still going very strong. I think that at least we have reached a plateau. We are looking very carefully always into the residual values of the car, of the length of the order bank, of the solidity of the customer base. And I have to say that we are still quite confident also for the months to come.
So Stefan, obviously through the first 3 quarters of the year, Lamborghini on pace for another record year of sales, doing well across a number of different regions. You have good sales of the Urus SUV and the Huracan sports car. And then, of course, the Revuelto just came out, and I know that order book is already sold out for a couple of years in the future. How has 2023 been so far for you guys, and what do you think 2024 kind of holds in the cards?
Right now today is the 6th of December, so I can say with a certain safety that it will be really another record year for Lamborghini in terms of sales, but also in terms of turnover, and also what concerns of our operating profit. We will deliver the results beginning of next year for sure. What is, giving us a good peace of mind is the length of the order bank by entering the year 2024. And this is not only valid for the North American market, but equally also for Europe, Middle East, and the Asia Pacific region. So if nothing goes south dramatically, also next year will be a very good year because, as you said, the Revuelto will hit in. We will have new cars hitting our sales men, and this is going to be very positive, not only for the brand, but also for our customer.
So Stefan, as the company sort of advances in the future, EVs coming, more hybridization, but also a new labor deal. I know you guys signed with the Italian Auto Workers Labor Union there, allowing for a 4-day work week, which is interesting because in the States, that was a very big high point of contention with the labor unions and also the big 3 automakers. How did that work for Lamborghini? Why does that actually work for your sort of production system that you have right now?
But I have to tell you that the full week is something which came up in the press. I don't know why and how, because it's not what we're doing. We are maintaining the same productivity. How we're doing it, and it's a very simple, recipe. We are improving the efficiency. We are going to have longer shifts. So this means that they will work the same hours, but they will be spending less time in the factory. So this is an equation which was done after a long discussion with the unions, with our workers, and now both parties are very happy. And so this is really something extraordinary for us, because it's giving us the certainty of productivity by at the same time giving them the opportunity to have more, let's say, time free in one stint. But 4-week day is something which is not right, and this is not what we are looking into. Then for sure, another positive result, but also because the company is going well, not because we are working less, so we need more people. No, everybody has to do his job in the right way, but we will have hirings of up to 500 in the years to come, also because of the force model coming into discussion. So this is another very good news for the company and for Lamborghini. And we will also raise the wage of the variables of our workers, and they will have also an extra bonus to celebrate the 60th anniversary at the end of this year, which will sum up to 1,063 euros. Dollar euro is approximately 108. So a 4-week is not a day, is not what we are looking into.
Lamborghini CEO Stefan Winkelmann, thank you for joining us today. And of course, our thanks to our very own Pras Submaranian as well.
Thank you very much.
And coming up, we're going to break earnings from GameStop and Chewy and bring you in-depth analysis. That is after the break.
All right, welcome to Yahoo Finance's group chat. Today we're talking earnings. We had a flurry of reports after the bell here in the last hour. I'm starting with the meme stock favorite, GameStop here. Miss on the top line here, 1.08 billion versus 1.182 billion, slight miss there. And then also a miss on the bottom line, EPS adjusted here, 18-cent loss versus an 8-cent loss expected. Cash and cash equivalents at 1.21 billion, so they're doing okay there. Interesting point that I noticed here in the flagged here in the report here. The board approving a new policy to invest in equities. I'm not sure what that means. Talking to our head of news, Miles Owen, saying that basically the meme stocks can now invest in other meme stocks. I thought that was pretty funny. Ryan Cohen just joined he left the board to go become CEO on the end of September. So kind of a lot going on here for the company. We don't know what's going to happen in terms of, there's no guidance here, so we don't know what's going to happen with Q4 and holiday sales and things like that, but a lot to watch here with the company.
Well, I think that's probably why you're seeing relatively muted trade, right? We just showed the stock down about 1%. GameStop.
Yeah, was that?
Yeah, moving a little bit to either side of the flat line, but overall not expected to have an earnings call again from Ryan Cohen. So you really don't get a lot of look into what's down the line for GameStop, which is I think what people care about when you think about a retailer that sells video games in person, right? That's a little bit of a foregone business that is not the business it was 20 years ago. So you want to know what the plan is for all of next year, what are the plans for growth, et cetera, and you just don't really get that from this company right now. So it's not much of a fundamental trade really on earnings, because I don't think the fundamental of GameStop really changed that much by just looking at the release.
Yeah, and Wall Street analysts have pointed that out heading into earnings. There was a note from Wedbush. Wedbush has an underperform rating, a $6 price target, and did point to some of those obstacles when it comes to how a company like this can sustain growth over time. Some of those challenges include the mix shift of game sales from physical to digital. The Grand Theft Auto video game, that was something that we're seeing going to go on Netflix mobile, and it's just one of those stories that you think about. A company like GameStop, how can they continue to innovate? How can they bring on new types of customers, new types of distribution models? How do they diversify and grow in a meaningful way? And it just seems like we don't have those answers right now. Then Wedbush also pointed out that the recent appointment of the executive chairman to the position of president, CEO, and chairman reflects the inability to attract some executive talent to come to this company and turn it around when there are all these overhanging issues.
Yeah, that really interesting point about that. Really quickly, that small move after hours is kind of surprising to me. Reading that the option skew data was saying it was imputing a 20% move in the stock after the bell, and it's really I'm surprised by this movement.
Well, it was up 20%.
It was up 20% just one day last Wednesday. When you look at a longer-term chart of GameStop, it got a little bit of that meme activity, and that's what I'm excited to see as we
after
watch.
hours move.
Right. Well, it'll be interesting to see what happens tomorrow,
Yeah.
right? When you get more retail involvement on a normal trading day, just the fact that GameStop's in the news. Does that make sort of the meme trade exciting, right? That's the fun part. That's the fun part of GameStop stock.
Not necessarily about the news,
Yeah,
right?
no, not
like
about
you're in the
news,
news, not about the news.
I know we don't want to talk about fundamentals, but real quick, the new Call of Duty game usually came out in the third quarter. It got pushed to the fourth quarter, so we don't have that data yet for this year. So we'll see. Might be a boost there for them in Q4, but we'll find out.
Well, Ryan Cohen, CEO of GameStop, he used to be the CEO of Chewy, and that's what I want to move on to. That's another stock we're watching today. Chewy, the online pet retailer, reporting earnings this afternoon. Revenue coming in at $2.74 billion, just slightly below estimates, while earnings per share came in at 15 cents, an increase of 4 cents year over year. But it's really guidance that's dragging down the stock right now. The company's saying it expects full year net sales between $11.08 billion to $11.1 billion. The estimate, though, was $11.24 billion. Chewy saying that guidance reflects industry-wide pressures, and obviously we know the consumer has been more squeezed, so it will be interesting to hear the comments on the earnings call. But along with those earnings, I also want to point out that Chewy announced David Reeder as its new CFO. Clearly, there seems to be a need for some new blood and some new management to help really bring this company back to where it could be. But analysts have also said this could just be a company that is near the end of its growth trajectory. That's okay, but you need to have realistic expectations.
That's the key here, right? So when you take a look at that Chewy net sales number, up 8.2% compared to the same quarter last year, right? That was growing at a double-digit pace for the last 4 quarters at about 14%. So we're coming down there. And when you think about Chewy, when it was a hot stock right after the pandemic, everyone was buying stuff for their pets, their sales were growing at an over 20% pace compared to the same quarter last year, right? So that's the metric that people are going to watch with a company that's sort of teetering profitability, a growth stage company You want sales to be in double-digit growth. You hear about that all the time with these growth stage companies, right? You want big sales numbers for us, and right now Chewy just doesn't have sort of the eye-popping sales numbers. The sales are there, they're growing, but it's not a wow, I can't believe Chewy's growing sales 20% compared to last year.
Right, you got that overall sales number, and also what about active customers, those people that are on there a lot? The subscription auto ship customers, that's a big part of owning a pet, right? You want that 40-pound bag of food to arrive there every week or whatever your dog eats. So I'm curious to see what those numbers are like. Are they growing? Are they just a churn lower? Is there any churn? Is there higher conversion of these users? So we'll see about that. So yeah, I mean, Josh, like such a big name during the pandemic, such a big, also a meme stock, right? And now you're seeing that kind of company go into its mature stage.
Right.
Yeah, well, there's going to be a lot to look out for in those earnings calls. But that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.